If you're looking for high-yielding dividend stocks, then you've come to the right place because in today's video, we're going to be taking a look at 4 stocks that currently offer investors a dividend yield of at least 8%. In fact, not only do these stocks offer high yields, but I've also gone through the process of running these stocks through a reinvestment calculator to look at the overall returns for these companies. And as of the making of this video, all the companies we're going to be taking a look at today have provided investors with positive returns since their inception, regardless if you chose to reinvest dividends or not. So we're not going to look at any stocks like Armour Residential, which has experienced substantial losses since their IPO. We're going to go through a variety of different metrics for these stocks, including share price performance, dividend distribution amounts, as well as look at their income statements, balance sheets, and depending on the company type, we're also going to look at their debt investments as well as their investment portfolios. I'd also like to encourage everyone to perform their own due diligence and research before investing in a stock and to come to your own conclusion. Be sure you're diversifying your investment portfolio across different holdings and sectors, which will help reduce your exposure to risk. So with that being said, let's go ahead and get started. The first company we're going to be looking at today is one that I haven't talked about before on this channel, and that would be TriplePoint Venture Growth, ticker symbol TPVG. This is a business development company that specializes in making investments in venture capital-backed companies at their growth stage. Having been founded in 2013, the company provides debt financing to venture growth space companies, which includes growth capital loans, secured and customized loans, equipment financing, and direct equity investments. They're an externally managed BDC and they're based out of Menlo Park, California. It currently trades for $17.22 per share, and right now their stock offers investors an 8.36% dividend yield. They issue dividends on a quarterly basis, with their last being for 36 cents per share. While they haven't increased their distribution amount since 2014, they have on occasion paid out a special dividend every now and then. The last time they paid out a bonus like this was back in early 2021. TPVG stock is currently up over 10% from a year ago, and it's up more than 24% from this time 5 years ago, which is pretty impressive for a BDC. TriplePoint Venture Growth is not like most business development companies that we've seen before in that they're pretty different in a couple ways. They exclusively like to focus on technology, life sciences, and other high-growth industries, and you might think that that's riskier since they only focus on a few sectors, and specifically sectors that carry a lot more risk, but I'll explain why that isn't the case here. TriplePoint also only lends to companies that are venture capital backed and during their venture growth stage. It's a very specific period during a company's startup process where a company has already proven themselves to have achieved a sizable amount of success and they're seeking additional funding in order to further expand their business. Other BDCs out there will lend money at other stages during a company's growth, or they'll provide financing to help rescue a company out of a dire situation through restructuring. But TriplePoint doesn't assist with these kinds of businesses. So in a way, this does kind of provide some protection, since in order for TriplePoint to consider offering a business financing, they would have had to have provided a lot of proof that they've already been pretty successful. TriplePoint's had a lot of success providing financing to businesses like Facebook, Square, Beyond Meat, Etsy, and a whole lot of other really recognizable brands. Over the last 5 years, their stock has provided some pretty phenomenal returns to shareholders. You can see that an investment in TPVG 5 years ago would have netted you a total return of 166.4% had you chose to reinvest your dividends. This is significantly higher than most other externally managed BDCs like Gladstone Investment, Oxford Square Capital, and Great Elm Capital. Overall, I think there's a lot to like about this company. They have a pretty solid track record in terms of their investment portfolio, and I think this unique strategy they have of investing in later stage venture growth companies has been delivering some pretty solid returns to shareholders. Next, we're going to look at a stock that's continued to experience a huge amount of growth in both its share price and its dividend distributions to shareholders, and that would be Armour Realty Trust, ticker symbol ABR. This is a company that invests in a diversified portfolio of structured finance assets in the multifamily, single-family rental, and commercial real estate markets in the United States. They're classified as a mortgage REIT and they operate in 2 different segments, which are structured business and agency business. Armour invests in junior participating interests in first mortgages and preferred and direct equity. Their stock trades for $16.92 per share and they offer a generous 8.39% dividend yield to shareholders on a quarterly basis. Armour Realty has provided investors with some pretty serious growth in terms of their dividend distributions and their share price. As you can see, the company has more than doubled their dividend distribution amount in just the last 5 years, which for a mortgage REIT is pretty impressive, and in fact, it's probably the best I've seen from my memory. In terms of their share price performance, you can see that this company got hammered during the 2008 recession, but since then they've seen a major comeback. Armour Realty Trust is structured as a mortgage REIT, which is a company that provides financing for income-producing real estate by purchasing or originating mortgages, and some REITs also purchase mortgage-backed securities. Just like how TriplePoint was unique for a business development company, Armour Realty is also pretty unique in their own way within the MREIT sector. According to their 2020 annual report, 92% of their mortgage portfolio is made up of bridge loans. These are a very short-term type of loan that companies will use while searching for longer-term financing options. A bridge loan can be under a year or two under normal circumstances, and they can be as short as 30 days if needed. As you can imagine, these types of loans are generally safer than longer-term mortgages because companies seeking bridge loans borrow for a shorter period of time, and the whole reason they're seeking a bridge loan is because they're looking for longer-term financing options for a project they're pretty confident in. Their fourth quarter 2021 fact sheet shows that 91% of their portfolio consists of multifamily loans. In other words, a large portion of Arbor's loan portfolio consists of companies wanting to purchase or upgrade multifamily or apartment properties. But I think what Arbor has going on with their bridge loans is a pretty good strategy. Like I said, they're short term, so they're less risky, and the people who borrow from them are less likely to default, because the whole reason they're looking for a bridge loan is because they intend to borrow even more money in the future. We'll have to see how rising interest rates will affect this company though. If the duplex sector does begin to struggle, I'm sure management will reallocate their bridge loans into other areas. Next up, we have Oaktree Specialty Lending Corporation, ticker symbol OCSL. This is a business development company specializing in investments in middle market, bridge financing, as well as first and second lien debt financing. Oaktree seeks to invest in educational services, business services, retail, healthcare, and manufacturing sectors, among many others. They seek to invest between $5 million and $75 million into each business, and they typically like to invest in companies located in North America. OCSL currently yields an impressive 8.6%, and they pay dividends on a quarterly basis. Over the past 2 years, this company has slowly been increasing their dividend distributions. They've been able to grow it every quarter since August of 2020, which is pretty good to see. If we look at the share price performance, we can see that this stock was on a downward trend from 2011 all the way until about June of 2017. With the exception of the pandemic plunge of 2020, its share price has slowly been recovering since then, and it's currently up over 11% from this time a year ago. Oaktree is a specialty finance company that's dedicated to providing customized, one-stop credit solutions to companies with limited access to public or syndicated capital markets. According to their website, they have a $2.6 billion investment portfolio, which makes them one of the larger business development companies out there. They currently invest in 140 companies, and they have a weighted average yield on debt of 8.7%. 70% of their portfolio is made up of first lien debt, which is something that I typically like to see, and their portfolio is comprised of a lot of software and medical companies. According to their latest investor presentation, this company has continued to grow over the years, with Oaktree now having over 1,000 employees in 19 different offices around the world. They've been around since 1995, and they have over $166 billion worth of assets under management as they've expanded their operations. It's pretty impressive just how much this company's been able to grow over the years, and their NAV has also been trending upward, and it's fully recovered from the pandemic. This has obviously been contributing to the constant growth in their dividend distributions, which hopefully they'll be able to continue going forward. The next company we're going to take a look at is Starwood Property Trust, ticker symbol STWD. This company operates as a real estate investment trust in the United States, Europe, and Australia. It operates through 4 different segments, which are commercial and residential lending, infrastructure lending, property, and investing and servicing segments. With a market capitalization of roughly $7 billion and a portfolio of over $24 billion across the company's 4 sectors, Starwood Property Trust has grown to become one of the largest publicly traded hybrid REITs. Right now, their stock offers a dividend yield of 8.21% and pays shareholders on a quarterly basis. Starwood Property Trust has never cut their dividend distribution before, which is great, but they've also kept it stable at 48 cents per share since the year 2014. In terms of share price performance, their stock is currently down about 4.8% over the last year, but it's up over 4.22% over the last 5 years, and it's grown by more than 48% since their IPO back in 2009. Starwood Property Trust is structured in somewhat of a more unique way than other REITs. A lot of dividend investors are aware that there's 2 major types of real estate investment trusts. You've got equity REITs like Realty Income that own physical properties, and then you've also got mortgage REITs like Annaly Capital that own pool of mortgages and not physical properties. Starwood Property, on the other hand, is what's known as a hybrid REIT, which is a company that owns both physical properties and mortgages. These are the least common types of REITs out there, but something to like about them is that you get equity with a higher than average yield for an equity REIT, and it comes with mortgages too. In their March of 2020 investor presentation, if we look at their portfolio breakdown, we can see that only 9% of their total investments are in physical properties, but make up 24% of the money that's issued to shareholders. The physical properties they invest in are largely within the multifamily and medical office sectors, both of which are doing pretty well right now. Starwood only owns 109 physical properties, so it is a lot smaller than their mortgage part of their business, but again, I like to think that it's a good idea since it helps with diversification in their holdings. I wasn't really too impressed with what's inside their financial statements. There's nothing really here that stands out, whether good or bad. Over the last few years, their net income and book value hasn't really been on an increase or a decrease over the years. The company does hold a lot of investments in office and hotel properties, which isn't something that I typically like to see with these kinds of companies, but everything's been going pretty well for the company as they appear to have attracted some pretty high quality holdings. In fact, some of their big name borrowers would include Blackstone, Brookfield, and Ares Management. And that's going to conclude our look at 4 stocks currently offering investors an 8% or higher dividend yield. Feel free to let me know in the comments if you happen to hold any of these companies and what your opinions are. Again, remember to always perform your own due diligence and research before investing and come to your own conclusions. Diversify your portfolio and spread your investments across different holdings as well. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.